so welcome everyone to our webinar today. While we get the attendees coming in, there is a lot of exciting news today in Singapore. We have a very big update on the restrictions that we have so far, which is exciting for anyone who is in Singapore. A lot more freedom to travel and go over to Malaysia and dining into bigger groups. So it seems like we're finally going back to some normalcy. How are things in Malaysia at the moment, HC? Is it
Actually, it's getting better, right? Because it went from 30,000 to recently below 20,000. That's why Malaysia and Singapore is actually opening up.
That's great.
On the COVID cases.
But do you guys have any restrictions, or is everything more or less like unrestricted?
We still have to wear masks.
Okay.
Scan the QR code.
Same here, same here. So I'm looking forward to seeing you all and have more freedom in Malaysia. So we already have quite a substantial number of attendees, and given that we have a lot to cover today, I suggest we really kick off the presentation and people can catch up to go along as we go along. Good afternoon, everyone. Thank you for attending our webinar today, which has a very exciting topic that we will be covering, the new OECD transfer pricing guidance that was released by the OECD in January 2022. So we TP enthusiasts started the 2022 with very exciting news and a lot of things to read and catch up on, and more importantly, what does it mean for Malaysian taxpayers? So before we deep dive into the topic for today, let me just do a brief 1-minute introduction. I know everyone is very eager about knowing what the OECD has brought into the table, but let me just start by giving an introduction about our firm. Basically, we specialize in advising multinational companies in the area of transfer pricing. I'm gonna quote my partner Hon Chuan here, which is that we really focus on helping multinational groups in making sure they stay out of trouble and be fully compliant with tax in front of tax authorities. So we basically offer our experience with dealing in disputes and audit to make sure that everyone stays out of trouble. Apart from also knowing a lot about implementation and pre-planning, so you can make sure that you don't get trouble since the beginning of setting up a transaction. We are 3 offices, our head office in Australia, our second office in Singapore and Malaysia, where we cater to the Asia Pacific region, to multinational with operations in the Asia Pacific region. We have been having several recognitions, such as Tier 2 firm, both in Singapore and Malaysia, and also winners of Asia Newcomer Firm of the Year. Let me just introduce the panel for today. So we have Hon Chuan Tan, who is our director and technical lead in Malaysia with more than 10 years of experience advising multinational groups in transfer pricing, and he loved building transfer pricing practice. Before joining TPS, he built one of the transfer pricing practice in KL for one of the mid-tier firms, and we're lucky enough to have him now with us. He's also known for having very technical views on how to make sure that he knows what the tax authorities are expecting from transfer pricing point of view. We have Kevin Tai also with us today, who is our senior manager for Asia with 9 years of experience advising multinational companies in Australia, Asia, and the US. And prior joining Transfer Pricing Solutions, he was with leading professional firms in both Australia and Malaysia. And for those of you who don't know me, I'm Adriana Calderon, the Director and Technical Lead for Asia, co-founder of Transfer Pricing Solutions Asia and Malaysia, with more than 15 years of experience in advising multinationals in international tax and transfer pricing across 4 different countries. So with that, let's just deep dive into the topic that we have for today. What we're going to do today is we're going to first discuss an overview of the TP guidance and why is it important, so everyone understands what's the real relevance of today's session. Then we will go through the key changes, and then what is the practical impact for taxpayers in Malaysia. So one thing that is really good to understand is why is it that the OECD is such a big deal? Why is it important in the transfer pricing world? And before we start discussing this point, it will be great to get some participation from the audience to understand how familiar are you with the OECD TP guidance. So I'm going to launch a poll for 1 minute, and it will be great if everyone can just participate and let us know so we can tailor the content accordingly. So the question is, how familiar are you with the OECD TP guidance? The first option is very familiar, and I read all these 600 plus pages. If you're one of those, we really hats off to you, because doing the 600 pages is somewhat daunting, but nevertheless necessary for anyone who is serious in transfer pricing. Somewhat familiar is the second option. I have read a few parts, not familiar, but I have heard of them, haven't heard of them before. So we have 72% participation in less than 40 seconds. Well done, everyone. We will leave it for 10 seconds more, and then we can just release the results. Where are you in, guys? Honchuan and Kevin, which one are you in?
Obviously, we'll say I've read the 658.
Didn't expect anything less from you, given that we are transfer pricing practitioners. How about you, Kevin? You're on mute. You're on mute.
Oh, sorry. Yeah, we have to be the one that, bite the bullet and read the 600 pages.
Exactly. So let me just end the poll now. So I will share the results. So obviously we have the majority in somewhat familiar and not very familiar, but have heard of them, and very little on very familiar and haven't heard of them. So not to worry, for those of you who are somewhat familiar or not familiar at all, that's what this webinar is for. And obviously we should be able to resolve your questions and explain how relevant it is for Malaysia. So with that, I pass it on to Honchuan, because it is important to put some context. So Honchuan, what is it that the OECD TP guidance is so important? And is it really the Bible of TP?
Right. Is it the TP Bible, or is it the TP Quran? Just to make sure we don't satisfy both.
Or important books. Let's just leave it like that.
Yeah, important books. Yeah, I guess it's good to understand the why the OECD TP guidelines actually affect us, right? So before we proceed to go through the key changes, let's first understand why it's important in Malaysia's context, right? So first, it is used by tax authorities globally as well, right? That's an important, significant point, because even the RRB will be looking at OECD guidelines as a reference to tackle all the TP issues. Secondly, it is the most comprehensive document in relation to the transfer pricing world, right? This is mainly because it has in going through all the feedbacks, comments, opinions from tax authorities, huge taxpayers, transfer pricing specialists, and has been continuously improved since inception, right? So that's important. And apart from being used by the tax authorities as a reference, it's also used as a reference in TP court cases, right, in conjunction with the local law globally. And lastly, even though Malaysia is not part of the OECD, the Malaysian TP rules and regulations adopted all the chapters within the OECD guidelines, right? Hence, you're able to see that most of the guidelines in different jurisdictions has more or less the same concepts or principles behind transfer pricing.
Thank you, Hon Chan. So for those who are not very familiar, can you just explain what's the scope of the OECD TP guidance, please?
Yeah, the scope is rather similar. So the scope starts from the arm's length principle and the relative the TP methods, and then they go on to the treated approach, which are the master file, local file, and country by country reporting, similar to the Malaysian one as well, just that it's separated from the TP guidelines. This is actually an implementation from the BEPS, Base Erosion and Profit Shifting Initiative, and then we have your intangibles, intragroup services, and cost contribution arrangements, business restructure, financial transactions, and lastly, dispute resolutions. Right, we'll be going through some of these later in the slides.
Thank you, Hon Chan. So we can say basically that from a policy point of view, OECD has set up the framework, and then each country has implemented it locally. So then it would be great to hear your views on what are the key changes from this new release, and what is the key changes that we should consider in the context of Malaysia.
I mean, as transfer pricing specialists, we've been eagerly waiting for a new version of the TP guidelines, and has been introduced back in Jan. And we'll go through the key changes, which are the revision of the profit split method, which will be hopefully be used more often than not. And then next will be the hard to value intangibles, and finally the financial transactions.
Okay, so let's start with the profit split, which probably you will explain some of the changes that have happened also in Malaysia. Just a reminder to everyone that we will have a Q&A session at the end, and you can post your questions in the Q&A box, and we can address it at the end of the session. So let's start with the profit split. Hon Chan, if you could explain to us some of the changes around the profit split method.
Yep. The profit split method is rarely used in Malaysia. Hopefully going forward, we'll be using it more. The TP guidelines provide additional clarity on the application of the profit split method and certain characteristics to aid in determination of when the method may be most appropriate. And the characteristics are unique and valuable contribution by each parties to the transaction, highly integrated business operations, and where it cannot be reliably evaluated in isolation, right? So basically, all the operations are highly integrated, you can't separate to appropriately test them. And then lastly, shared assumptions of economically significant risks, or separate assumption of closely related risks, meaning both entities will be sharing those risks conjuncturally.
Okay, so if you could tell us in practice what is specific details covered or are covered by the OECD TP guidance in relation to profit split.
Yeah, for that one person that read the 600 pages of the OECD TP guidelines, you will know what I'm trying to say here. So according to this updated guidelines, it emphasizes on that the presence of reliable comparables for that particular related pay transaction will make it unlikely that the profit split method is the most appropriate transfer pricing method. Having said that, the absence of these comparables also should not automatically result in the profit split being the most appropriate method, right? So because the guidelines further emphasize this point by providing examples where the first 10 out of 16 total examples attached in the annex illustrate that whether profit split method is or is not the most appropriate method to determine a correct remuneration. Right, there are 16 examples there. It's good that for those that are interested, you can go through those 16 examples to sort of have a clear understanding whether profit split method can be used. The guidelines now also provide clarity on how to apply. As per the previous guidelines as well, including Malaysian TP guidelines, there are two types of analysis. One is the contribution analysis, and another one is the residual profit split. Right. Regardless of the type, the starting point is the function analysis. It's crucial in applying the profit split method. Right. This method should be aligned with the function analysis as well as the delineated in play. After that, the profits have to be aligned to match the appropriate accounting period. Right? You have to make sure that both entities' accounting period are matched accordingly. Then only then you can use the appropriate profits to be split. Then after that, it must be determined whether you're going to use a gross profit or a operating profit, net profit. Right? So in circumstances where gross profit may be used would be when operating costs differ for both entities, right? Or if they each fulfill they have their own activities in addition to the joint activity, the joint contribution activity. Then after that, after determining whether gross profit or operating profit is used, the last step would be actually to determine how to split the profit, right? The guidelines mention a few factors, more on objective factors, where examples that can be used are a set of capital used, incremental sales, number of employees, or employee costs. There are other factors deemed appropriate as well if you deem those factors to be more appropriate to split the profit accordingly, so long as they are objective and verifiable, right? These are key. You need to make sure that they're objective and verifiable before using those factors. Then only then you can use those factors to determine the split.
And probably this will make more sense to the audience once we give the couple of examples that we have to explain how this works. But what is the Malaysian view on this, or how does Malaysia TP guidance adopt the profit split? So if you could just tell us your views on this so we can understand what is the Malaysian way of the profit split.
Yeah, and I guess for those that have not recently visited the Malaysian TP guidelines or the LHDN website, the LHDN has actually made several changes to the website as well as the TP guidelines to include or to be more aligned with the OECD TP guidelines. For now, the main differences in the Malaysian TP guidelines, it's still the hierarchy of methods. So in Malaysia, the hierarchy of methods is still in place, which means that you have to go through the traditional methods, which are your comparable uncontrolled price method, your resale price, and your cost plus, before then going to select the transactional methods, which transactional profit methods, which are profit split, as well as the transactional net margin methods. Right. So that's the main difference between TP guidelines and OECD guidelines. And apart from that, the use of the profit split method is actually quite simple, where it emphasizes on highly integrated business operations as well as the unique and valuable contribution by each entity. These two are the key these two distinguish between using a profit split or not, right? The clear indicator. And lastly, it's also important to note that the global formulary apportionment is actually not accepted by the IRB on the basis that they are arbitrary and could not reliably approximate arm's length conditions. Right, this is very interesting because it involves one of the Pillar 1 proposals, where they are talking about using the global formulary apportionment in relation to arm's length conditions. So I guess this is another development that we will see from Malaysia, whether they will, when Pillar 1, Pillar 2 put in place, maybe then they may change their opinion.
Thanks, Hon Chuan. I think it's interesting the fact that you have to fulfill the hierarchy, highly integrated business and unique value contribution to be really able to use profit split in Malaysia, right? Yeah. So let's go with a couple of examples. So the first example is just to explain how the contribution, which is for those of you who just joined. So we are talking about the profit split method, and we have two types. One is the contribution and the other one is the residual. So we're going to give first an example on the contribution. So Hon Chuan, all yours.
So contribution. So in this example, simple example, we have two related companies. Both companies provide design services that are highly valuable to the creation of the IP within the group. So hence, you have a unique and valuable contribution, and you have a integrated business operations within the group. And it's hard to separate these design services as to which one is more valuable or not. Hence, you have to go through the profit split method. And using the contribution analysis, in the next slide, you can see the table to assess the contribution provided by both entities, right? If you look at the table there, you have the respective functions, thereby the contribution by each entity, right? From there, you determine the percentage and the weightage of each functions, right? In determining how much percentage should company A has contributed versus company B contributed. This is a simple example just to see that you have 40% company A, then 60% company B, right? Obviously, in practice, it's not that straightforward, right? You have to go through the function analysis to make sure that all these contributions are put in place. And then one of the main challenges is that there's not a appropriate test with a third party on the contribution analysis. Hence, contribution analysis are actually not applied very frequently. And then once you have determined the contribution, then only then you can use the respective profit split, gross profit or operating profit. And then obviously you can also go through objective factors as well, as we mentioned earlier. And also one important thing that also Malaysian TP Guidelines has is that taxpayers will also need to test the net profit outcome after the profit split method via benchmarking to make sure that both entities would have still satisfied the arm's length principle based on the benchmarking, and that the margin earned by both entities would have fall within that arm's length interquartile range. So that including profit split, you have to prepare benchmarking to make sure that it satisfies the arm's length principle of the TP guidelines.
Thanks, Hon Chuan. Kevin, are you also having a bit of difficulty with Hon Chuan speaking? That goes.
You can't hear me.
It goes, or is it only me who is getting that?
I've heard him quite well.
Okay,
just
maybe
a random drop.
Okay, yeah, that's what I felt. Okay, so maybe it's only me. That's okay. So Hon Chuan, going back to the point, so I think the profit split contribution, what we're really saying is that in practice, it's applied when you have highly integrated, mainly businesses, or in the random event that you have two companies only doing IP, but even in that event, you might go down the residual, and then the expectation of IRB to still have a benchmarking to test the net profit outcome.
That's correct.
Which makes it sometimes makes you wonder whether you should go down the path of this. But anyway, that's what we have to deal with. So now maybe it would be great if you could give us an example then on the residual and how the residual is different to the contribution.
Yeah, okay, so another one is the residual profit split, right? So in this example, we have two companies. The first company is actually a developer of the IP, as well as they patent the manufacturing technology as well, right? The parent company. And then company B is they provide R&D activities which further enhances the technology that company A has, as well as a contract manufacturer to manufacture the final products and sell it back to company A, which was on sold back to the party. Right, in this scenario, you can see that obviously the core IP is in company A, but then company B would have enhanced the technology, further providing unique and valuable contribution to improve this technology and increase the value of this technology, thereby allowing company B to manufacture the final product to be sold to company A, right?
Yeah.
So in this case, now residual profit split has two elements. First, I guess we can go to the next slide,
Yes.
where we look at the routine activities of, well, first we determine the group profit first, to look at on a consolidated basis, what's the overall group profit by company A and company B. If you look at the example, the group profit is actually $45 in this example, right? By consolidating both financials and making sure that they are of the same accounting period, right?
Mm.
Then secondly, there are two-step approach on the residual profit. First is to determine the routine, then the residual, right? Step two is the routine contribution. And when we say routine contribution, which means that we are looking at the routine activities apart from the contribution of the unique contribution to the IP, right? We take up the unique contribution, we look at the routine activities that's performed by both companies. So company A, the routine activities actually sell the final product, right, to the end customer.
Mm.
Company B, the routine activities actually contract manufacturing of the final product, right? So once you have determined the routine activities, you need to benchmark, right? Benchmark the respective routine activities for each company. So after performing the benchmarking, in this example, company A would need to earn a 25% operating margin, right, based on the benchmarking results, and company B will need to apply a 6% markup on costs in relation to their manufacturing activities. So you look at the table, in order for company A to achieve the routine return, the gross profit will be $31.25, and company B adding the 6% markup, they'll earn a $6 gross profit. After which, we deduct the operating expenses, thereby them earning a routine operating margin of $16.25 for company A and $1 for company B, right? So overall, the total routine profit of the group is $17.50. Right. So hopefully everyone get a copy from there. Once we have determined the routine profit, now we will need to look at what's the residual profit after the routine profit, right? So which means 45, the overall profit is $45 minus your routine profit. Thereby you have a $27.75 of your residual profit to be split, right? And in step 3, to determine how to divide or how to allocate this residual profit, we have used the factors of the R&D and marketing expenses, which based on this example, this factor is deemed the most appropriate factors to be split. And company A has has incurred $12 of expenses, then company B has $3. And percentage-wise, on the weightage, 80% goes to company A and 20% is company B. By calculating the allocation, then $22.20 to company A, and then company B will earn a $5.55, right? Once you have added those two together, company A would have an adjusted operating profit of $38.55, and company B will be earning a $6.55, right? So in this scenario, it shows how that profit split, residual profit split will work, right? How first we go through the routine, then only we split based on the objective and verifiable factors, and then allocate it accordingly based on the percentage.
So the objective allocation key here is the R&D and marketing expenses, right?
Yeah.
Which is
Exactly.
verifiable and objective in the sense that it has some value or that can be objectively quantified.
Yeah.
Okay, thank you, Hon Tran. So let's talk about now how hard to value intangibles and what is the change and basically what is the view from Malaysia point of view?
Yes. So I guess hard to value intangibles HTVI. Before we look into the HTVI guidance, let's first look at what are intangibles assets in terms of Malaysian transfer pricing. Okay, intangible assets, by definitions, is assets with no physical preference. It's a unique product valued for their intellectual or intangible contents. In Malaysia, broadly, intangible assets can be grouped in three broad categories. You have the trade intangibles, which can be, for example, your product developed through extensive R&D, the know-how you have developed over the years of operations, the unique designs you have on your product that gives you a competitive edge in the market. Then you have also marketing intangibles. Now, this is a bit more interesting. It is actually a special type of commercial intangibles, which can include your trademark, your trade names, marketing strategy, customer lists, customer relations, customer data, the types of assets that helps you market your products. And then moving the next one, you have government licenses and contractual rights. These are rights that grants companies special privileges or exclusivity. For example, this contract can be something like an exclusive supply contract that you have to supply certain types of pharmaceutical medication to the government hospital. Grant us exclusive right to mine certain raw materials in Malaysia by the government. These are all considered intangible assets. Just to be careful with the contractual rights, this is a bit different from your day-to-day, distributor supplier agreements, which they are just part of your normal operation, doesn't provide you with additional competitive advantage in the market unless you were able to obtain a very rare, unique product, exclusive right for very unique products to sell in Malaysia. Okay, so that is what in Malaysia transfer pricing we view as intangibles. Now moving into HTVI, the HTVI, this is a term to use to describe intangibles or rights to the intangibles, which at the time when you transfer the intangibles, there is no reliable comparable exists in the market. Take for example, if you are introducing a very new technology that into the market that there's no other technology that is similar to yours, then looking for comparable obviously is not possible. And this then make it very difficult to predict the level of success that the intangibles can have or expected profit that will be generating by these intangibles. Okay, and what does this all means, right? This all means basically when you transfer an intangibles, usually you will have a valuation process to work out what is the value of the intangibles, so you can transfer it on an arm's length price. Because of the unique nature of the HTVI, there is a high risk that your prediction, after all, valuation is a prediction of future events. It's not likely that you will get 100% right or 100% accurate. So the risk of having wrong valuation is high on HTVI. So you could end up with a significantly higher or lower price when you sort of compare your valuation with the actual result for a few years down the road, which is what we mean by ex ante projection versus ex post outcome. Mm-hmm. So what the guideline says, okay? The guidelines provide tax authorities the possibility to determine in which situation the pricing arrangements set by taxpayer are arm's length. So under the guidance, tax authority are entitled to consider the ex post outcome, which is the actual outcome. If they are significantly different from your valuation, then there is a presumptive evidence that indicates that the valuation that you have done at the time of transfer is not accurate or is not appropriate. And what does this all means? So, yep, tax authority then are entitled to consider any other relevant information that that relates to your intangibles that becomes available to the taxpayer. I mean, tax authority, which reasonable can be expected that taxpayer would have at the time of valuation, but have not included that into valuation. They can consider those information. So basically what it means is they don't only need to look at the valuation that you've done and the parameter that you have set. They will also look at other factors that they think is reasonable that you would have at the time, but you have not considered. And how would that impact your valuation? Mm-hmm. Okay, so basically in applying this HTVI approach, tax authorities can make appropriate adjustment to allocate the profit between the related parties, or they may even make an adjustment to change the structure of your arrangement to reflect what a third party would have done. And this is basically the core principle of the arm's length principle, the core concept of the arm's length principle. If the pricing is not right, tax authorities can adjust it to reflect the arm's length price, or your structure is not right, they can adjust to reflect what a third party will do. Okay, so with this guidance, what it means in practice. Okay, so the guidelines has indicated, value-based evaluation can be appropriate because obviously you can't find similar comparables to potentially do a CUP analysis. So valuation can be appropriate, but in addition to just doing valuation, there are certain best practice or safety measure that you can put in place to increase the robustness of your analysis, to minimize the discrepancy between the valuation and the future outcome. Okay, we have included 4 here as a guidance. First of all, have a reliable valuation analysis before you dispose of your intangibles. Consider all factors that may impact the valuation and make sure it's well documented. Second of all, maintain constant monitoring in the post, basically the actual price, actual value versus the valuation you've done. Evaluate whether or not there are certain things that happen in the market recently that may have impacted your valuation a few years back. For example, the COVID cases may have impacted your evaluation because of the market change. Okay. Obviously, the third one, try to have the valuation done as close to the date of disposal as possible. Obviously, do not use a valuation done or 5 years old valuation to set your price for your disposal today. Lastly, try to have close to about 20% margin of error. Like I say, valuation is a projection of future events. You may not get 100% accuracy all the time. Having a margin of error can mitigate the risk of substantial adjustment in the future.
Thank you, Kevin. And what is the Malaysian view on the intangibles and some of the new concepts that we have now in the very new update that happened actually just last Friday? So if you could tell us a little bit about that. Yeah, so from a Malaysian view, it's still the same. There's a requirement to use the arm's length price for transfer intangibles as always. This is a very important piece. But also when you think about arm's length price, you also should consider what the HTVI raised. There are certain challenges in determining the arm's length price for certain HTVI. Obviously, when you think about transfer of intangibles, you think about who is the ultimate benefactors. Then you need to work out the ownership of the intangibles, and this should be worked out through the DEMPI concept. Now we will talk about this DEMPI concept in the following slides, but generally it's a framework to work out who has contributed to
the creation and the value of the IP. Next, we also have to have regards to the concept of marketing intangibles. This has been increasingly popular over the past few years, especially for taxpayer incurring AMP functions, administration, marketing, promotion, whether or not they have contributed to the value of the IP. Obviously, R&D and improvement process is also a factor that should be considered, because this also directly contribute to the value of the IP. And again, guidance of the valuation technique that we have discussed earlier should be taken into consideration to ensure that you have the best you are in the best position possible.
It's interesting to see how Malaysia has codified specifically the marketing intangibles and the R&D and processes, because I guess they're trying to make sure that they protect the type of intangibles that are mostly created in the Malaysian context. So if they exist, they can also make sure that the taxpayer in Malaysia is being remunerated appropriately for that intangible. So can you explain us a little bit of this DEMPE concept that can be quite new maybe for some of the attendees, and what is the impact of Malaysia adopting that concept in their e-tax guide?
Yeah, so DEMPE, I'm sure most of you are quite familiar with this concept, but for those that are not familiar, DEMPE is a framework introduced by OECD from the Action 8 to 10 of the BEPS initiative back in October 2015. It's basically a framework to map out who has contributed within the group, who has contributed in the development, enhancement, maintenance, protection, and exploitation of the intangibles. That's where you get the DEMPE from. This, initially in the past was one of the factors that's driven the OECD to come up with this DEMPE approach is to combat certain multinational that use what we call the post box office to exploit to profit shift their revenue from a high tax jurisdiction to a low tax jurisdiction or to a no tax jurisdiction. What they basically did was to set up a registered office with no substance, no employees, just a postal address in the tax-free jurisdiction, and transfer the intangibles there. And they start charging license fee to all other members of the group. When the DEMPE comes, it's just to address or just to highlight who in the group that are actually contributed to the development, to the enhancement, maintenance, and protecting the IP, and obviously who are the one that is exploiting the IP or getting benefit out of the IP. And that's the overall framework of DEMPE.
Thank you. So essentially a mechanism to prevent putting all your profits in that PO box that you're mentioning and bringing it back to profits being split among the companies who have substance from an employee point of view. Thank you, Kevin. Before we move on to questions, let us go through the key changes on financial transactions. For those of you who don't know, Kevin loves financial transactions, and I'm sure he has been eager waiting for this section to talk about financial transactions because it's one of his favorite topics, not to mention that he is very technically brilliant at it. But I let you talk about the scope of financial transactions, Kevin.
All right, thanks for the pump. But financial transaction is one of my interests. As always, there's always a learning curve. I don't claim to be knowing everything about the financial transaction, but this is one of my interests. So the scope of financial transactions, is quite broad. It includes, how you delineate the actual transactions. It talks about treasury functions. It talks about intragroup loans. It talks about cash pooling, hedging, guarantee, and captive insurance. But if you look at, financial transactions, where is the starting point? And it's the same with all intercompany transactions. It's the intercompany contracts. right? That is the first starting point. It gives the reader or the tax office a high-level overview of how the transaction is structured, what are the key terms and conditions, what are the pricing, and other relevant information of the transactions. But one thing to really remember is that the contracts that you have to reflect the actual transactions, because there is this always substance over form clause that the tax office will always look at if you, regardless what your intercompany contract says, if the actual transaction, for example, your loan, is not reflective of what it says in the illegal agreement, they can disregard your legal agreement and look at the actual transaction itself. Okay. From this guidance, what are the key practical aspects? It basically tells us how to apply transfer pricing principle to financial transactions. Okay, and as with all other transactions, nature of the transaction is always the starting point. Starting point for pricing any financial transaction, as well as any intercompany transactions. But the guidelines also sort of raise the importance of also considering the capital structure of the group, because sometimes I've seen companies that keep adding on intercompany loans to a level that is not commercially viable and it's not sustainable, and that begs the question whether or not a third party would have done the same thing. Okay, but all right, with that, let's move into the treasury functions.
Before you move into the
sorry.
treasury functions, just a point here which you raised, but I think it's just really important that the issue always with financial transactions is the fact that we also have a more stringent legislation in most of the countries of how you determine the nature of a particular financial transaction, especially when the challenge is whether you're talking about an instrument that is debt or equity in nature. So that's why this OECD guidance makes such a big comments on the importance of sorting out the nature first, then move on to what is the arm's length price, which is very strong in comparison with the prior TP guidance, I have to say. But yeah, please, if you could just talk to us about treasury centers.
Yeah, so treasury centers, now this treasury functions is always it's quite common in the bigger groups, in the bigger multinational. Usually you will have either a treasury entity, separate entity, that manage all the treasury activities of the group, or you will have a division, a treasury division within the head office that does all this. The OECD guidelines tries to highlight what are the common treasury activities that you will see in the multinational group. And this can broadly be grouped into three categories again. You have the management side, you have the market-related side, and you have the intercompany side. Management activities will include, they are most like, they're generally internal. For example, like your cash and liquidity forecasting, working capital management, cash management, treasury control, and risk management and management advice. These are all internal. And then you have the market related, which is there are some sort of interaction with the market. Which, for example, if you are a big enough entity, you may have your credit rating published or rated by an agency. Then you have to manage, credit rating agency relationship, manage relationship with a bank or debt investor, fundraising for the group, where you go to the market to raise funds, investment management, and market hedging. And then the next one, you have intercompany, which is your loan and credit facility management, your guarantees, cash management include cash pooling, hedging, captive insurance, and debt factoring.
Sorry, I changed it to early.
That's all right. Yeah, that's fine. So these are all some of the common treasury activities that you can see that get potentially charged across the group. Maybe next we'll go into intragroup loans.
So
sorry.
Kevin, what is the relevance of these three categories of activities? Do they have an impact in the way you go about the arm's length price? Is that correct?
Yeah, it depends on how the level of activity involved by the Treasury, and how, and because the different type of activities generally, if you can group it into a higher value, lower value type of activities, and that will impact how you are going to determine your remuneration that you need to pay to the Treasury.
Yeah, thank you, Kevin.
Okay, so if we look at intra-group loans, now we are moving more and more into a two-sided perspective approach. In the past, we tend to be very one-sided, looking at the borrower perspective. But now you can see the shift of going into a two-sided perspective. We are looking at both the borrower and the lender perspective. What this all means, when we look at the borrowers, we have to sort of assess whether or not they need the funds, like we say, whether or not it is commercially feasible for them to take these funds, whether or not the funds is used for operational requirement, and whether or not there are any realistic options available in additional to this intergroup loan. From a lender's perspective, we evaluate what makes the lender go into this loan, but what's drive the decision on the value of the loan, what are the key terms and conditions, and the risk factors of the loan. Okay, how we can do that? Broadly speaking, we look at the credit asset. We can do a credit assessment, and we look at the commercial consideration. When we talk about credit assessment, is to identify and evaluate the risk involved, and consider whether or not there are any methods that we can put in place to monitor and manage the risk if the risk is quite substantial. Okay, and what this all means, how do you do that? There are a few things that you can do. First, you have to understand the business. You have to understand the purpose of the loan, whether or not it is just for general working capital, or whether or not it is used to invest in a very high risk investment, or how is the loan structured, and how would the borrower source their income to finance this the repayment of the interest and the loan. Obviously, the other side will be the commercial consideration. We need to think about what is the credit worthiness of the borrower or the group. What is the credit risk, which also part of the credit worthiness, and the economic circumstances they are operating in. If you combine these two together, it gives you a pretty good idea of the risk profile of the intragroup loans, and then it will then lead into how detailed you need to be when you're doing a transfer pricing analysis to support the interest rate.
Thank you, Kevin. And last but not least, cash pooling, which are becoming a bit popular these days.
Yes, cash pooling. It used to be just among the big multinational, but now we are seeing more and more cash pooling arrangement in Malaysia as well. When you talk about arm's length price for cash pooling, it really is just looking at the reward received by the cash pool leader and the cash pool members. In the cash pool arrangement, generally you have a cash pool leader, which could be your treasury or your head office, and then you have the cash pool members, which is the subsidiaries of the group that participated in the cash pooling. When you look at the reward for cash pool member, is basically the interest rate they receive for excess cash they put into the cash pool, and the interest rate they pay when they have an overdrawn balance in the cash pool. For the cash pool leader, it really depends on what type of cash pool and how much they are managing the cash pool. So you can have a notional of a physical cash pool, which the cash pool leader may have different involvement in managing the cash pool. Obviously, the more involvement the cash pool leader has in managing the cash pool, the higher the reward should be.
Thank you, Kevin. And what are the things to watch out from Malaysia point of view? before we enter
Yeah.
into question.
Yeah, so from Malaysian TP perspective, the guidelines is generally consistent with or the OECD guidelines, but because intra-group loans is the more common financial transactions that you may see on a day-to-day basis, the Malaysian guidelines focuses more on that. But other than the TP guidelines, you also need to, in Malaysia, you also need to look at the earnings stripping rules, because it doesn't matter how robust your analysis is to support your interest rate, but if you get caught under the earnings stripping rules, potentially you will get part of the interest deduction denied under the earnings stripping rules. So just have a think about that.
Thank you, Kevin. So with that, let me just open for questions then. We have a couple of them. Anyone who has any other, please feel free to post them now. So we have one first question, which is for Malaysian entity that charges royalty license fees to its local and overseas related party for use of internal developed software, which TP method can be used to determine the arm's length rate? Who wants to have a go?
I guess that is a very good question. It really depends on, now this is a very typical answer when we say it depends on the facts and circumstances. It's almost feel like we are giving you a general answer, but it does depends on facts and circumstances. You can use a CUP analysis. Like I say, if it's not a hard to value intangibles, comparable data is not hard to find, and there is actually just basically the internal developed software is responsible or is developed by one entity. CUP can be the one. Otherwise, like Hesi say, Hongchuan say, profit split. If there are multiple entities that comes together to develop this, because you need to sort of determine who is entitled to get how much of the profit out of this IP or software, or the exploitation of this software. So it's a combination between your DMP analysis that I've discussed and the profit split that Hongchuan has mentioned earlier.
Any views here, Hongchuan?
Same. I think what Kevin said. Yeah, I think it really depends. I think we really need to look at the fact pattern before we decide what method to be used. That's the most important part.
Yeah, and I think is more than looking at the price first, is more looking at the nature of the structure, because you more than what percentage you get, you have to address the issue of the ownership, because the ownership will drive the who gets some revenue out of or profit out of the exploitation. Okay, so there is another very interesting question. Does that mean that if a holding company charging treasury service fee to the group member subsidies, then interest-free loan is allowed, as holding companies manages the funds from other group members?
Okay, so I think this is sort of two different things, right? Treasury service is a remuneration for the administrative work they've done to manage your treasury related activities. Interest-free loan is a some sort of cash you advance to your subsidiaries, and whether or not it should be interest-free or interest-bearing, it really depends on a few factors, whether or not this could be considered an equity injection. Meaning then you have to look at whether or not they have the subsidiary have the capacity to actually pay, or whether or not that structure allows for that. And obviously, if it's not, then potentially it should be an interest-bearing loan.
Yeah, and I would like to emphasize that RRB do not like interest-free loans, and even in the guidelines specifically say that if upon assessment that it is indeed a loan, not an equity, then it should be an arm's length, meaning interest should be imposed on that loan.
So I guess what we're answering is, because the question is a yes or no, so I think our unanimous is no, because one thing is the Treasury service charge and the other thing is the remuneration. One is the remuneration for the Treasury service and the other one is for the usage of the cash, which is basically driven by the likelihood of default of the borrower. So you don't, doing a Treasury service charge doesn't automatically allow you to do an interest-free loan. And then there is one more question, which is any recommendations how to obtain transfer pricing case law, local and overseas? Apparently not much information can be found in IRB website.
Yeah, I guess IRB won't put all the cases in there. And Malaysia one, there's a handful. Obviously the popular one is like an MN case. Recently there's a landmark case and also a Shell case. I mean, all these are publicly available, but I guess this gives us an idea to put more cases into our website.
Yeah,
but
potentially
actually,
the TPS website.
Actually, apart from the TPS website, there is, I'm going to give a very pearl of wisdom here. There is a public website called TP Cases. And in TP Cases, you can find cases from anywhere, but you just
I think they have Malaysian cases. I went there before.
Yeah. So for those that are not aware, Adriana is actually a lawyer. So she knows where to get the case law.
Okay, there is another one. For interest-free amount owing from foreign related parties entities, will this be an issue given the new role of foreign source income? Will IRB impose tax plus penalty on deemed interest income based on arm's length rule?
So if I get this right, what we are saying here, if there's a interest-free amount that's that went out to the foreign related parties, if IRB decided that this should be interest-bearing, will they impose tax plus penalty on the deemed interest? The answer is, I believe, yes, because if they treat it as an interest-bearing, then they will say that in the past or for the past few years that are under review, there should be an interest charge. Then they will then make a TP adjustment to say that this should be your income, and then potentially a penalty will apply. Yes.
Okay, so I think
there's one more in the chat, Adria.
Oh, okay. Let's see if we have one more. For financial transaction, is bank borrowing rate a good comparable for intercompany rate? If not, why and what other factors have to be taken into consideration?
Okay, so bank borrowing rate is generally not a good reference for your intercompany rate. Reason being is the bank interest rate is to the general public. It's not tailored to your risk profile, to your creditworthiness. One of the key impact that the key factors that may impact the interest for intercompany loan or any loans will be your default risk. So if we are not just looking, if we are looking just on publicly available bank borrowing, those are the rate that they provide to the general public. It's not tailored to your specific requirement. You could have a very good AAA rating, then the interest rate may be much lower. Or you can have a very bad or very low credit rating, then the interest rate could be higher. So it really depends on your circumstances, how high is your default risk, and obviously how long is the term is the term of the loan. The longer the term, generally the higher the interest rate will be.
Yeah, and I think the other aspect is that at least in Malaysia, we don't have indicative interest rates that the IRB has said that is acceptable. In Singapore, we do. In Australia, we do. In other countries, we do. But I think Malaysia haven't taken the stand of putting out there what they consider to be an indicative interest rate for low value loans or for certain loans. So without that, then you get very little room to work with bank borrowings. All right, so for those of you who want to keep engaging with us and looking at our content, please subscribe and like our YouTube channel, where you will see all of us publishing content of different transfer pricing topics that we hope they are of interest. If there is a topic that we haven't covered, feel free to send us an email to say, hey, you haven't covered this topic, do you mind covering it? And if you want to contact any of us, here is our details, now a phone number, email, and website. And thank you very much, everyone, for coming and spending 1 hour of your afternoon today. Thank you, Kevin and Hon Chuan Tan, for your insightful and valuable contribution. And we hope we can see you all soon. We have a webinar every month, so keep an eye on our upcoming webinar. We have one on the 31st of March that will be covered the region, China, Hong Kong, and Asia. And we have another one coming, I think, is on the 21st of April. But keep an eye on our social media channels, where we are always publicizing. We are in YouTube, Facebook, LinkedIn, Twitter, Instagram, you name it.
Yeah, we are basically a TP media company.
WhatsApp and any new channels that come, we will be there. Thank you, everyone, and see you soon.
Thank you.